Welcome everyone. This is Jean McDowell with TradersCoach.com, and I want to wish everyone a Happy New Year. This is the first Wednesday Night Live of 2015, and we're thrilled to have Price Headley with Big Trends on for tonight's presentation. I'd like to go over a few administrational items before we get started. For anyone that's not familiar with the GoToWebinar platform, just want you to all notice that there is a questions area where you can ask questions to our speaker, and if you would all just type a yes or a Y in that area so that I can be sure you found it, that'd be great. It'll also tell me that you can hear my voice and see the screen. So for those of you that are in the room, if you've got a yes, terrific. Kathleen, Daryl, good to see you tonight. Paul, great. Everyone sees the questions area. So I know Price will want to be looking at your questions and help you with your options expertise. And the other thing I want you to notice is that I also have a section in the chat area where we'll be posting very important links. I just posted an important link that is the recording link that you can access the recording of tonight's webinar tomorrow, so you can save that link. If you see that link, just again give me a Y or a yes, and if you don't, let me know as well, and I'll make sure that we get that posted for you. And terrific, great. Terry, Kathleen, great. I'm glad you can all see that. Well, Wednesday Night Live is designed to bring new education material to you each and every week on Wednesday at 7:30 Eastern. And tonight we're thrilled to have Price Headley from Big Trends, and Price appears regularly on CNBC, Fox News, and Bloomberg Television, and he's a terrific educational speaker, and I know you're going to learn a lot of wonderful things from him. He's going to be answering all your questions about how he swing trades monthly options as well as weekly options, credit spreads, debit spreads, and ETF options. So I know you'll have lots of great questions for him, and he'll be giving you lots of terrific information. And Price, I think I'll turn it over to you, and thanks for being here.
Well, thank you so much, Jean, and hello, everybody. As Jean said, Happy New Year. Thrilled to be with you. I also have my lead consultant with me in on tonight's webinar. Chris Sayre will be helping answer questions through the chat box even as I'm going through the presentation. Then I'll come back towards the end and pick up questions too. So do post your questions as they come to you. We're going to talk about what we call our Big Trends Trading Education Spectacular, really trying to get you focused on the importance of laying down the right processes for trading. Sometimes it's not the sexiest idea to talk about a process for trading, but you know what? The idea is if you've got a solid process to take you through day to day in the heat of battle, you can actually really set yourself up for a much more effective trading plan. So we're going to talk about how to really configure your trading plan tonight. Ultimately, just a quick reminder that everything we share with you here in tonight's webinar is geared for your information and education only. I will take a look at current markets, but do remember that nothing we talk about here tonight is geared for your geared to be a buy or sell recommendation. You need to know, of course, that we're just purely educating here tonight, and that you are solely responsible for any investment decisions that you make. We do also encourage you to always make sure you check with your tax and financial advisor before you make any investment that might impact your unique financial and tax situation. So, what we want to talk about is, how to really accelerate your learning curve. I know Bennett and Jean there are also big believers in the power of education. That's why we love doing stuff together with them, because, when you lay a solid foundation educationally, you can really accelerate your trading success. You can also make sure that you're minimizing really excessive risks. Every trade involves risk. We all know that, whether you do a trade or an investment, but the bottom line is it's about managing that risk and putting yourself in a position to be more effective over time and be in the game for the long haul. So, the reason that trading for a lot of people is difficult is that they think that they can just convert one bit of expertise or knowledge and then they can basically master the markets. You figure if you've got a good market timing method that tells you when to get out, when to get in the market, when to get out of the market, you think, well, that ought to really be a big help, and that if I can just focus on that, I can really do well in the markets. But you know what? If you get greedy and you overcommit your capital, if you don't use the right kind of money management strategies, which, as I said, getting greedy, that's a psychological component. These things go hand in hand. I know Bennett talks a lot about the proper allocation of capital too. That's what's going to keep you with a solid foundation, a solid base, and that allows you to build off of that and leverage that. For us, it's about knowing the right technical indications that the market is positioned to rally or to drop. You've seen plenty of volatility in the last several months especially. We're going to talk about what that means and where the market's likely headed. And then what I like to do, as Gene mentioned, is I like to really leverage it with option strategies. So to me, that's the last piece after you build these other pieces, because you want to make sure you've got a solid foundation to leverage off of. And then ultimately, frankly, the reason we're going to talk about multiple option strategies tonight is because you've got to know yourself. You've got to see what's the best fit for your own unique temperament. Some of you are more risk averse. The fascinating thing to me is that when I launch big trends, speaking of launches, looking at the space shuttle launch, I launched it because of being real successful throughout the 90s, and in particular in the second half of the 90s with the massive acceleration takeoff that we had in tech stocks and other big movers, and then was able to say, okay, I'm ready to go start my own firm and help teach other people about how to find these big trends. And then what's interesting is that then the markets went through that readjustment in 2000 and 2002. And of course the Great Recession of 2008, and we actually taught people how to make money on the downside through a number of those type of choppy to down environments. So the key is, as long as you know how to adjust, you can really position yourself. But a lot of people are a lot more risk averse now than they were 15 years ago when I launched big trends. And the biggest rule I can tell you is, whatever type of trader or investor you are, is you've got to have a written trading plan. And so you notice written is an important word. Now, before I ask you, I'm going to ask you all if you can just tell me if you've got a written trading plan or not. But before you answer, let me ask you a quick caveat. If I told you had a little time to train somebody, sufficiently about what your written trading plan says to do, and that you're going to take a one-year sabbatical away from the internet connections and away from the world to kind of recharge your batteries and see a different part of the world, and not have access for a year, and come back a year later and say, would you be confident that somebody could follow your existing trading plan to the letter? Let me just I'm not going to name any names. Just type a Y or an N, yes or no. Would you be confident that you've got enough of a plan in place right now? And we've got an immediate yes. So 2 thumbs up there, but a lot of you saying no, and that's understandable. We've got a couple more yeses. Good for you all. And I know we've got a little more advanced group through all the coaching and education you've already been through. But the bottom line is that a lot of folks realize that, you know what, you might have some blind spots, as I like to call them, in your trading plan. You might have some areas where, you know what, if you're not aware of what's coming in the blind spot, you might just get run over by that 18-wheeler. We don't want that, and nor do you, obviously. So we want to help you to evaluate some of these key pieces of your plan and say, everybody assumes, if I get entry right, get a really good entry, that's going to give me a huge edge in the markets, right? That's the first assumption, but the reality is that you can have good entries and still get yourself in trouble if you start overcommitting capital, and also if you don't have the other good pieces that go with this. So this is just kind of the starting point. And I'm glad to see one of you said you have a written plan, you stick with your plan, you trade your plan, and you can never learn enough, and you're glad to be here. Applause to that, Rodney, because, yeah, you always want to be, as I like to call it, green and growing, not just in your portfolio, but in your mindset, so that you're always constantly looking to push yourself to the next opportunity, the next level of success, and constantly be growing rather than ripe and rotting. We never want to see that, right? So you notice what I keep saying here is you should write these things down. Write down what's your clear catalyst. What is your real driver for getting into that stock move? It could be a technical indicator, could be some kind of a gap on earnings or some other kind of a news-driven trade. But the key is once you start writing these elements down of what's getting you in, what's getting you out, even whether you're trading this with real dollars or I encourage you to start small and build, you can even paper trade first as long as you're writing it down. Paper trade is not the same. Real dollars obviously involves another emotional component, but you got to start somewhere and build, okay? So, and then once you get confident, then you can start with real money on a small level. And the beauty of trading in the markets is if you've got a good idea and it's working, you can scale it up over time, gradually and steadily, as you build confidence and as you build consistency, which is what a lot of my big trends traders tell me they're looking for. I literally did an event to kick off the year, and about 60% of people said their number one goal was consistency, so I would imagine that's also on your mind. Now, when we talk about specifying a system, a method, the time frame you're going to trade, this is really easy to get yourself really confused with all the powerful technology that we all have at our fingertips. When I started trading in 1990, I was so excited out of Duke University. I had a Quotron at my fingertips, and I just thought, okay, this is like the movie Wall Street or whatever, or, the next Gordon Gekko. But the bottom line is, you know what, that was nothing compared to the power that you have at your fingertips. And the key is harnessing that power, making sure that you're not confusing yourself looking at too many different things. And so it's very important to define these key elements. What's your objective? How are you going to start taking money out of the markets? And what's your stop before, and that's the key word in that little part there, before you actually get into the trades. You've got to pre-program your mind and pre-program for looking for the kind of opportunities that give you the right risk versus reward relationship. So I'm going to share with you a couple of those tools tonight, but I'm just laying some key groundwork here first in these concepts, and then we'll get into the nitty-gritty looking at some of the charts. But the bottom line is, you know what, once you define the entry, obviously exit's on your mind too. How do you get out? As the old saying goes, entry is easy, exit is hard. Anybody can get into a trade. It's how do you manage the trade that's a very important part of the equation. And so, we've got to define what's that first stop point, where what I say is where the trend is invalidated. I'm always talking about market structure. If the structure of the trend is still good, we don't want to cut off our opportunity flow, at least keep part of our position on to keep riding a valid trend. But if the structure of the trend is invalidated, why are you holding on to the trade anymore? How many times have you been in a trade where you feel quote-unquote stuck, where you literally should have gotten out, you should have let the stop take you out, you didn't, and now you're asking yourself, well, what do I do now? Where's another spot I can get out? You're stuck in that trade that you shouldn't be in. If your edge is there, you should give yourself a chance to take advantage of that edge. Everything that we do at Big Trends is based on systematic testing of a variety of ideas. Literally, I've been through thousands of different ideas. And the idea is, okay, do I have enough of an edge that can overcome the cost of trading with commissions and give me enough positive alpha, if you will, is another term for it, where you're basically exceeding the typical return that you would expect from just a randomized approach. So what we also need is we need a trailing stop. Of course, that's where we get in and then it starts to work for us, and we've got to have a way to kind of gradually ratchet up our stop without getting too tight. A lot of you might be gun shy from past experiences where you want to use a really tight stop. I think you've got to be careful. You've got to give yourself enough room to let the markets do their normal wiggle, their normal retracement, and not get whipsawed out of an otherwise good trend. So we're going to talk about big trends today, and a lot of traders look at moving averages like the 10-day or 20 simple moving average or even the exponential faster moving averages. What I find is you'll see, like on this chart, actually, a moving average might take you out. You see this is looking for quick moves. On the longer-term trend, that little moving average break takes you out on that break below that gray line, and then it resumes its trend. So part of what I look to develop are ways that can maybe get away from some of that noise that's flushing a lot of traders out and look at what I call the true trend rather than that sort of fake-out based trend. So I'm trailing my stops based on what I consider to be new inflection points. So I'm not going to raise my stops every day, but only when we get a new key point being seen. So just to give you a taste of that, we'll go look at somebody type in a stock symbol that you want to look at. We'll go look at a particular stock symbol and just share with you a quick little way that we would do that on any given stock or market average. Okay, so MO, Terry got in there first. Actually, MO was a great example. I'm glad you mentioned it, Terry, because we actually talked about Altria Group, part of the old Philip Morris, back in late November, and we bought options that ended up going up 100% on the first piece and 200% on the rest. That's kind of an unusually large target that we went for, but we liked it based on the rules of our system. Now let's show you what we were seeing here with Altria real quick. Okay, so let me pop that up. And so So what we're looking at here, let me turn on my %R system, and okay, why is it giving me that? Too many bars back. Okay, let me fix that real quick. We like to use TradeStation. TradeStation, I know there's a lot of different packages you can use, and the bottom line is that you can figure out exactly. This is a %R breakout system, as we call it, and so basically saying, okay, let's just give it a little more data so it can pick up those signals, because we're looking at the long-term trend and the short-term trend here. And so, okay, I'm just popping it in my %R breakout system, as I call it, and so you see MO nice and steady, okay, even on the most recent signal. November back here, it was already breaking out. And so what are we looking at on this particular buy setup here? We've got very specific entry and exit criteria for this particular, any of our particular systems. But in this case, you can see when it starts to go overbought on this lower panel here, this is the %R, what a lot of you may be aware of. Some of you may not have heard of it. It's the % range indicator developed by Larry Williams. Now, I'm a believer that if I can find anything that gives me an edge in the markets, I'm going to take advantage of that, okay? And so what we did back here on this particular trade is, you know what, I don't even have to catch the first leg up of this last buy signal that it had back here, but I say, look, the first buy signal happened when we broke out, and then it closed above that high. In this case, the very next bar is buying. The next bar is open there, about 47.5. And you know what? That first move happened, and I wasn't a part of that first move. That happens sometimes. We had other bullish positions on. Maybe we don't want to get too committed to the bull side, so if we hit too many bull trades in a row, we'll back off. But when MO backed off right here to 48.5, that was back there in mid-November. And it's doing it again right here. See how the %R looks like it's coming out of this overbought territory. I like to use the grade school scale, 0 to 100%. So I give you this indicator kind of core setup so you can actually go and look at it on your own platforms and see what's happening. But when it retests this overbought line, after it's on a buy mode, see the last one that happened back here, August and September, we had a retest right there in mid-September, and it tested around that support right here, and that took off again. That retest is not only a place to reset your stop, but it's a place to consider adding or entering a position if you're on the outside looking in and saying, you know what, if it closes underneath that low, for MO it was 48.71 on that last one that came up there, we told people, okay, at that point you'd want to go ahead and bail on that particular trade. And it didn't, and what we had done is usually we like to buy options that are a little bit more in the money, but we said, you know what, this is part of what we called a holiday trader special package of trades that I sent out to a select group of our Big Trends clients. And so I said, you know what, when I did these trades back here, it was right before Thanksgiving, and so it was a fascinating time to do this, where I said, you know what, let me just show you the MO trade real quick as an example. We said at the time, let's go ahead and get a piece of this MO trade here, and this just to give you a taste of the kind of analysis that we do. These trades are already closed. We had a phenomenal run of trades from Lilly, Lululemon, Teva, UAL, GDX, GME was a put, so was GDX. A phenomenal amount of success. And then I said, you know what, here's a bonus trade. This has now been closed. We said buy to open, this was back here right before Thanksgiving, so about a month away from the December expiration. And this was a little more speculative one. I said buy the December 50 call at 40 cents or better. You say 40 cents or better, that's only $40 a contract. But like I just showed you, Philip, the old Philip Morris, now Altria Group, you talk about the cigarette business, and now they split out cigarettes and food and all kinds of other stuff. But the bottom line is he said, look, this is a really aggressive trade, bonus trade, aggressive idea on Altria Group to buy that 50 call. And we said sell half of it if it gets to a double up to $80 a contract, and said if it gets to a triple up to $1.20, remember it's a $50 strike call. If you're new to options, what that means is you've got a right to buy the stock at 50. So essentially, if it gets intrinsically up to 51.20, that's got to be worth $1.20. We paid, $40 a contract, and then ended up selling out the rest of it just up there at a triple on that second piece, a double on the first piece. So it's an aggressive idea, and so Chris says he only sees part of the chart there. I was just trying to show you the idea that we got into. Now, look at what happened here. is that the stock started to take off. Now, why was this option so cheap? Well, because you assume that Altria Group is not a tech stock, right? You assume that, therefore, it shouldn't be that big of a mover. But you see, it had already been proven that it was going up strongly. It went from 42 to about 47.40 in the matter of about a month and a half there from early September to mid-October. So we're saying, look, if we buy a month out, we're only a point away from the strike price, and then you see what happened. It went up above that 51.20, 51.25, and hit our target for a triple. Okay, let me share my screen again, make sure that that's coming across so you can see that. So we were selling it out into this rally about a week later, so the first half as it gapped up. Part of the reason these options were cheap was because they were going to pay a dividend around about a week before Christmas. Okay, they're paying usually a kind of a large dividend right in here. So people were worried that, oh, well, they're paying that dividend, that would knock down the call option value, and so therefore they weren't pricing it very highly. So we were able to lease that stock's movement, in this case, for only about a week's action, going up 100 and then 200%. Those opportunities don't come around all the time, but when we see special situations like that, we like to alert our clients. Now, we want to focus you on the fact that to do that, to find those kind of opportunities, you want to educate yourself first. You want to be aware of what you should be looking for, okay? So the bottom line here is that, okay, when you're getting into an option trade, what I like to do is I like to use what I call limit orders, okay, and good for the day only. So we call them day limit orders. Because what you're doing is when you send your order to the options floor, you're telling the market makers, look, this order is going to be out there at this price for today only. If you don't fill it, then basically it's going away, and it may not come back tomorrow. If you put a, quote, GTC, or good till canceled order, you can get yourself in a bit of a pickle where they won't fill it until it's absolutely in their benefit to fill that order. We don't want to send that message. Now, on the exit, I may use a market order if I absolutely have to get out, but usually what I'll do is use a limit order to sell to close for the day, and I'll put it maybe just a hair under the bid price, so I make sure I can get filled if I need to get out. Because the limit order on the way in allows you to define your risk and reward really clearly on the way in. But when you need to get out, the market order, the limit order with the bid, a price just under the bid, will help you to make sure you're getting out and not having to monkey around with changing your orders when it's time to go. Now, the fourth point here, we talked about capital. A lot of people get started in options and think, well, hey, I can get started and buy it for just a few $100s for a trade, but so they don't fund their account very much, and then they're basically putting in too much per trade. There are definitely economies of scale as you start to increase the capital you trade, but we do tend to recommend in the neighborhood of 5 to no more than 10% of the capital that you allocate for one given system or trading idea or methodology. So we're not talking about your whole portfolio. We're talking about just to essentially break out a small piece and then only trade 5 to 10% of that per trade. So then as you grow your capital and as you get confident and can apply more capital to it, you can really then benefit that way. We'll get into some more charts here, but I want to lay a little bit more foundation. As I said, 5 to no more than 10% per trade, per strategy, right? So we're not talking about the whole portfolio. If you had $1 million portfolio, I wouldn't be saying put $100,000 into this next idea. I'd be saying take a piece of that and then basically trade no more than 10% of that little smaller piece. So it's always good to start small and build. If you're really confident in an idea, a full position for me would be the maximum allocation. A half position would be half of that maximum allocation. Now, a big goal that you should have, and when you look at your risk per trade, when you think about an options portfolio, let's just say you're trading, say, $10,000 in an options portfolio, and you say, okay, well, I'd like to have a goal to keep my total portfolio risk around 2% per trade or less. Where do I come up with that number? That number is I researched from a lot of different past great traders, and it started with my research in the book The Market Wizards by Jack Schwager. And I took an average of all those people's average maximum portfolio risk they were willing to accept, and it came out around 2.2%. Okay, so just a hair over 2%. So I figure, okay, that's a pretty good. Let's model the masters, and let's go ahead and say, okay, think about that for a second. So what that means is if you were taking a $10,000 portfolio, putting 10% per trade in, you'd be talking about $1,000 into a trade. What that would mean, if you're talking about not losing more than 200 of that 1,000, which would be 200 on 10,000 or 2% of the 10,000, that means that your stop needs to be around 20% for the option. If that's too tight of a stop, then maybe you need to trade a little bit less so that you can actually still accept that no more than $200 risk. Okay, so obviously if you're investing a huge part of your portfolio on a trade like that, you would have to have an even tighter stop, and I wouldn't recommend investing that much per trade. So you can see as you invest, say, that maximum 10% of 10,000, that's a 20% loss that leads to a 2% portfolio risk on that trade. So this really kind of opens things up. Now this graphic always sort of, definitely catches your attention because it's all about focus these days. The more you try to do, the more things can get out of focus and get almost like that hyper warp speed feeling, right? We want to make it to where we can slow time down a little bit and really focus on that key element at a time and not get too extended in too many different ideas. I find that most great fortunes have been built based on concentration rather than being too diversified, where you just end up getting kind of the market return. You can really build your wealth if you can focus and concentrate on relatively fewer ideas. Now, I'm not saying load it all up in one idea, but what we find is in that neighborhood of about 5 to 7. So what I've found is about 6 is my usual cap of where I don't really like to go over, and a lot of times I'm in the 3 to 4 range at a time of trades that I might be working in any given portfolio and system. This will help you. If you're getting more ideas than that, if you're looking at too many different stocks or markets, you might want to tighten up to go to the best of the best and to make sure that you're executing well. And then, how many of you, let me ask you another quick question, just a why or an in. I'm not going to put any names on the spot. I'll just call them out. How many of you would say that you keep a daily trading journal recapping how your trades did? Even if you're using a longer-term system, that you're kind of recapping what's going on a day-to-day basis. Just type a Y or an in the chat box. Because you want to make sure that you're constantly learning from what's working in your portfolio, as well as learning from what's not working. Let's face it, not everything works. The idea, literally a lot of what I'm sharing with you today as we look at some of my favorite systems and methods, is based on literally years of sometimes trial and error and seeing what didn't work to get to what did. As Thomas Edison, I think, said, he knew he had to find the answer to the light bulb because he had found thousands of ways for it not to work. So he knew that the answer for it to work was eventually around the corner, right? That's called persistence, right? So the idea here is that I like to note in my daily journal my observations, especially as it comes down to what I would call execution. Okay, so how many times have you known what you should be doing, whether in trading or in life, but you didn't pull the trigger? You didn't execute. You didn't take action when you needed to take action. You got to grab that brass ring when the opportunity is there. And you say, for a lot of people, why are you not taking advantage of it? It's usually some kind of an emotional trigger, and I'll get into that here in just a little bit about those key emotional components that you've got to factor in. I also like to do what I call a post-trade analysis every month and at the end of every quarter too. So, when we get to the end of a given calendar month, you look at your closeout trades from the past month. For the quarter, do the same thing. This is what I call a post-mortem that'll go ahead and give you sort of like a recap of what went right, what went wrong. And this will really help you to be focused on minimizing future errors and also looking for what I call winning patterns that I've gone on to call my success profile. Okay, you think about it. What's your success profile? What is the pattern that typically leads to success again and again? Again, there's never going to be 100% consistency on that, but it's like there are lots of systems where you can put the edge strong in your favor and keep your losses small and let your winners run. That's actually the nature of just about every good trend system. So for me, some of the common factors that exist for really massive long-term trends, believe it or not, if you go more than 100% above a 200-day moving average, that can be an incredibly powerful long-term trend. I was talking with one of my fellow analysts about that earlier today, and we're talking about some of these movers. Like when you think back and you look at a stock like Tesla, you think, well, Tesla, gee, nice to be a part of that, TSLA. That was the 100% above it kind of first alerted me to that thing breaking out last spring. And let's just go back here for a second. Spring before last, actually, in spring of 2013. And you see what's happening here. Remember we talked about the overbought market. You can see these are my acceleration bands in the purple line. These are longer-term Bollinger Bands, which actually will help you to see the really big breakouts when it moves outside of it. That first big move on Tesla in the spring of 2013 was basically a doubler for the stock in a matter of about a month. It went from on the buy signal 47.98. You see it got up to about 115, more than a double. Stopped out right about a double there, just under $93. And then it got you back on the wagon for another run up and yet another run up into the fall. So the point is, if you have, that's another good lesson, by the way, if you have success with the stock, you need to have a re-entry strategy to get back on board. You can see we'll get in as long as it doesn't violate our key support on a closing basis. We're able to participate. You'll see violent little reactions. That was yet another retest. If you missed on the first one, this little snap down under that overbought level, you'd learn through our big trends methods how to buy the dip, what I call the retest method, and take advantage of those kind of extreme sort of flushes, especially for those high volatility stocks where you can actually, instead of being the one getting flushed, you can take advantage of that and really jump in there. The percent R above the 80 level for the top 20% of readings for bullish trades and the bottom 20% for bearish. It's counterintuitive, isn't it? But it's very powerful. The acceleration bands is really how I first founded big trends, off of the bubbles that kept blowing up even into bigger and bigger moves. ADX should be trending higher. We look at the 14-day ADX. We developed something called the efficiency ratio, looking for very clean, efficient trends. So a lot of these pieces of the puzzle you learn from big trends over time. Now, what about position review? We're going to get into looking at a few more charts here, but you've got to have a routine every day to close out your day if you're actively trading day to day. If you just trade week to week, you're working a day job, that's fine too. Do it every week. You don't have to do this. If you're using a weekly chart, for example, you should only do it at the time frame that's relevant. So I tell people that use a weekly chart, wait till the end of the week. Don't overreact during the week. Review your trades, assess if you followed your plan. By the way, big trends methods apply to pretty much any time frame, from quick day trader types, swing trade. We get a lot of swing traders, and then, of course, more position traders to even intermediate term proactive investor types. Definitely log all your trades. Constantly learn from what's working, what's not. Actually, what I also encourage you to do is, if you're really strong on an idea and you didn't pull the trigger and you said, I like that one, but I thought it was too overbought and I didn't want to chase it. That's how I actually found this overbought system to actually start taking advantage of trades I was missing before, because at first I had a view, like a lot of you have, that overbought was bad. It's not necessarily bad to have a stock that's overbought. You think about other stocks, for example, like Apple, and you think, Apple's been a phenomenal mover, obviously more recently. So it's been a little heavy here lately, but, you look back at Apple and you see in 2014, Apple, of course, is by far the biggest market capitalization stock, but after a good earnings report this past April, it kept going up, told us to buy it there as it broke out under $82, and then ran it up about 10%, up over 90, actually stopped it out at 91.51, kind of chopped around for a couple of weeks. And you got a couple of choppy signals in there that didn't do much, even a couple that stopped out quickly for small losses. But then you see, and look, even the worst loss on that one, if you bought it at 99 1/3 and had to stop it there at 94.75, you say, ouch, that would hurt. That would be down to like $4.50, $4.60. You say, but hold on, I just told you that you made more than $10 on that move. And look at the move, of course, that you had right here, where it went from 105 to 119, up 14 points. And you should be booking some profits, because by the time this one had that little quick flash crash, if you will, back down there at the start of December, it got a little choppy before the exit happened. Right now, we're on the outside waiting to jump in on one side or the other for Apple. Right now, it's in the no man's land. I would not be trading it right here. But the point is, trade something while it's in a good mode like this, and then know when to move on to other ideas along the way. So that assessment process helped me to start getting on board those tops, those types of trades, I should say, and getting on top of them. Now, what's your preparation process? You've got to get yourself in the right mindset, even the right physical set of you got to feel energized, you got to feel alert. Because look, let's face it, if you pulled an all-nighter the night before, you're probably going to be a little slow on the trigger the next day, or a little jittery either way, and you don't want to trade that way. You want to trade from a very calm, kind of zen-like, mind-like water type of state of mind. Nothing's going to rattle your cage, because then you can execute with consistency. Now, define time to prepare for the next trading day helps you build your trading confidence. I like to prepare after each day's close for how things are setting up, run my scans, and help me really formulate a plan of action before I get into the heat of battle. That's called proactivity, rather than just getting in there right before 9:30, seeing which way things gap and trying to chase a gap or trying to react to that gap. That's got you already in reactive mode. So we want to be proactive, not reactive. And the final question, you say, what broker will you use? The brokers, these days are so much more cost effective than they were when I got started in trading 25 years ago. I remember once sending an order in when I first got into option trading in the early 90s, and I had to call it in, and then it was with a new broker that I'd moved some money to, and then basically I was watching my quotes run, saying, okay, why hasn't my order filled? I know what it's going to look like when my order fills. Never went through, and I called them, and they're like, oh, we had to send it up to the home office to get approval before we could actually place a trade. I was like, are you kidding? Send me my money back right now, right? So the idea was, in those days, that looks like so much the Pony Express Stone Age compared to now. You point and click, and you're boom, boom, in and confirmed and filled, and you can be boom, boom, back out. That's one of the reasons I love the investment markets compared to most other investment opportunities. When everybody was psyched about real estate back in the early to mid-2000s, and I was saying, you know what, this is not going to end well because everybody's going to be in a vehicle that once you're in, it's harder to get out. You need liquidity not just on the way in but on the way out. So a lot of people think on the broker side that commissions are the number one factor they've got to focus on. In my experience, really, commissions are relatively a small cost. They matter. There's no doubt about commissions matter. But they've come down so much that really you want to focus on your broker's effectiveness at executing your trade. We actually have several brokers that automatically trade our Big Trends recommendation programs. And if you'd like more information on that, Chris Sayre can get you more details if you're trying to find the one for options that can get you really good fills on the way in and even more importantly on the way out. Okay, now with all that work done, we're going to come in and look at some charts here in just a few. So I know everybody loves to look at those charts and get an eye full of what we're doing here at Big Trends for the last 15-plus years and how you can take advantage of that here and make 2015 your best trading year ever potentially. But what happens is you do all that work. Your number one sin in trading, in my opinion, is when you don't follow your plan. Your ego badly wants to get involved and say, oh, your ego knows better. Your ego thinks you can override your plan because your ego wants to take over and say, hey, we're in this game to be right. We don't want to be wrong. You know what? The reality is that, sometimes taking a little risk in trading as part of a process to find out if you're on the right side or not is part of the game of trading. And the key is, can you do it in a small enough way that you can contain that reward punishment cycle that might affect you not being able to take your next trade? Your ego badly wants to be proven right. And that's something you got to battle in your trading. The reality is, think about it. All of us have had our whole ego-based system strengthened throughout our whole lives when it comes down to schooling, where you're constantly rewarded for getting the right answer, and you're punished for getting the wrong answer. And then same thing in the work environment for most people's careers before they get into trading. You're constantly being rewarded for, making the quote-unquote right decision, the positive ROI decision, and you basically get punished for, one that's not positive, right? So the idea here is, there's a lot of traders that I know, and I've been through this myself, where, I can actually have certain trading systems where I can be right a third of the time and still make a lot of money. Now, for a lot of people, that's not what you want. A lot of you are looking for higher win percentages than that. But you know what? If I tell you, you lose one. So say you lose $100 and you lose another $100 in the second trade, and on the third trade you make $500. You say, hold on, so you lost 200 on the first two overall, and then you made 500. You netted out plus 300. That's averaging plus $100 a trade. Could you handle that? Could you stick with a couple of losers in a row, or even a few losers in a row, and be able to be around for that bigger winner? And then if you can't, then you should be focused on higher win percentages with probably lower net gains, but obviously greater consistency. So we have all kinds of different structures that can help all different types of traders, and we'll walk you through that here in just a little bit. But the bottom line here is you want to make sure that if you're fearing the outcome, you've got to commit to a certain amount of time where you can just say, my only goal is to follow the rules. This is where if you've gotten yourself so bollocksed up by past trading losses and losing confidence in yourself and in your methodology, sometimes you do have to go back into the virtual trading environment and just start saying, okay, I'm just going to take this trade. When I get an entry, I will say I will buy this in a virtual trade, and when I get an exit signal, I will sell it. And then do that 10 times in a row without any hesitation, and then do it another 10 times in a row, and you're probably ready to go back into real money on a smaller scale, and then ease in, because real money is still different, right, psychologically. But your number one first goal should be, I'm going to follow the rules. And that makes it very important then to trade small and build your confidence, and that puts less focus on the money at first and more focus on committing to the discipline of execution. So, now there's a great book, a lot of you have probably read it, Reminiscences of a Stock Operator, and in that, it's based on the life of Jesse Livermore, who lived 100 years ago, and these principles still apply because they're about human emotions, and the human basically human element still drives the markets even with computers abounding. He said the speculator's deadly enemies, the four of them. He said ignorance, greed, fear, and hope. He said all the statute books in the world, all the rule books on all the exchanges of the earth cannot eliminate these from the human animal. I love that term, the human animal. Think about it. What would you say, type in the chat box for me, what separates humans from the rest of the animal kingdom? What would you say is the main separating factor? Anybody have a guess or a thought? We think about it, and there's a word to give you a clue, thinking about it. It's the nature of our brains. We all still have that initial early stage, what they call reptilian brain, right, that's more about that fight or flight response. But then we've evolved with the neocortex and the other elements of the brain to actually have that rational thought. Vincent says choice. That's another good way to put it. But, we're talking about that rational thought and that ability to actually, hopefully a lot of you have the ability to see past the very moment that you're in and just that constant reactive fight or flight response. That's the reptilian kind of sort of primitive level of the brain. It's like that survival instinct, right? But you're trying to say, okay, look, we want to get from survival into success. So we want to start looking past just, how do we put food on the table today and say, yes, that's important, but then we want to think about how we're putting food on the table for the rest of our lives. So we want to look bigger picture. We want to make sure that this is the right fit for what we're seeking to do. Now, obviously you've got to control those fears, and some of these ideas are adapted from other great trading experts out there. I would say this one is from Mark Douglas's work on a great trading coach and psychologist on the 4 fears of trading. And as a fellow trader, Mark Douglas realized that fear of losing, of course, is a big one that we all have in life and in trading, fear of loss. And so a lot of people cling to what they have for fear of losing the little bit they have rather than stretching themselves. So you have to say to yourself in trading, where is my stop? Can you actually handle getting out there? And in my most my best attempt, I should say, at my best Jack Nicholson from A Few Good Men, he would say, can you handle exiting there? Can you handle the truth? The truth in this case is the markets are telling you that the market's going to do what the market's going to do. Your job as a trader is to handle that and say, okay, it's telling me that I'm not on the right side here. I need to move on, get out, and live to play another day. Fear of letting a winner turn into a loser. I see so many traders that got beat up by the Great Recession financially and psychologically that basically now they're in that mode of taking very small gains, and then they're not willing to take a loss quickly enough because they're hoping it'll turn around, and so that's not the secret to success. You want to flip that around and have quicker losses and let your gains have a chance to run on at least part of your position. Now, fear, when I talk about greed, my definition of greed is when fear has left the building, okay? So greed to me means if you've lost all of your fear, that some might call that overconfidence, but I would say greed is when basically you're so confident that basically now you don't even feel any fear. That's dangerous. A little bit of fear can be very helpful because it can prevent you from doing really dumb stuff. That a little bit of fear can allow you to say, okay, I'm not going to load all my capital into this next trade. I'm not going to do something dumb that could blow me up, right? So the idea is that we want to always kind of ground ourselves and make sure we have just that healthy level of understanding about the risk of any trade. And then the fear of being wrong, like I said, that's the ego need to be right all the time. And so be careful about analysis paralysis. Try to tighten your methodologies to, something you can really take and follow consistently. And so I always say start with one key element like the percent R, and then you can build around it. So you have to say to yourself, what's the worst that can happen? You don't want to trade too large, so you trade smaller, or you start building the habit through virtual trading, and then you build up into real trading. This can help you manage your stress a great deal. Don't assume the next trade is going to be like the last trade, especially after a good run. Don't assume that, okay, now we're really going to load up and make it big even on the next winner. That's dangerous. And then, of course, after some small losses, don't assume that the system stopped working. You've got to define that what's the level that I can commit and follow that system through for a defined period of time. So start small and then build, and always focus on consistent execution first, and then you can focus on building up size, and ultimately then it goes from there. Now, add only a low-risk entry. That's where we were talking about the percent R retest. Somebody give me another stock besides the ones we've already talked about. For those of you that came in late, just type in the stock symbol that you like to follow. We'll look at a couple of these in kind of a quick lightning round before we're done. But, basically, so you say, okay, Chipotle, CMG, right? So Chipotle, you can see, let me pop it over here 1 second. This is the daily chart. You can do this on any intraday chart. One of you is asking about the intraday move that Chipotle had. You look at it over here, and I look at a lot of other things too, but you see on the 15-minute chart for you quick traders, Rodney was saying, did we see that Chipotle had a nice trade today? Yeah, actually, this system was saying to buy CMG this morning at 679.90, and see how it stayed overbought the whole day? So actually it went from 680 to about 694.5, up about 14.5 points from that last buy signal. So you see the prior one actually ended up not doing anything. It got you in at about 671, got you out at 670.5. You lost a half point, and then today, as of the close, you're up 14 points. Okay, I can handle that kind of risk versus reward ratio, and hopefully you can too. You can see it was kind of edging down the prior couple of sessions. We look at, that's just for quick trades. And then you can see also on swing trades over here on the hourly. We've got other confirming indicators on here too. But you can see a kind of nice little hourly move over a period of several days on CMG, Chipotle. Love the food, and the stock's been a great trader too, right? So you can see it had an upswing, then it had a downswing. And notice, first quick stop out on the loser side on that last one there, you can see it basically knocked you out for about a quick almost 7-point loss, and then it caught this one from 673 down to a low at 653. It made you 20 points on the downside before it started to then reverse back the other direction for a smaller gain on the rest. We want to sell part of our gain, and then we want to let it ride. Okay, one more, IBM, says Mary. Okay, so I always start with the big picture, look at the daily first, and then you can work your way down to the other time frames. I was mentioning to my trading workshop students before the last earnings report on IBM how it was just breaking down. You can see there's where the earnings came out, and it gapped down about what? It closed at 182 and it opened at 167, so down 15 points. And you can see since then it's been edging lower still. Guess what? The stock gave a percent R sell signal at 186, about 4 points higher than where the gap happened. Let me ask you a quick question. Do you think it's possible in any way that maybe the word gets out among institutional managers about bad news might be coming on IBM before the earnings actually hits? Do you think that could be perhaps a possibility? Would you say yes or no? Or do you believe in efficient markets and that therefore all information is assumed, and that if people knew there was bad news, it would already be way down here? If you believe that, you could say no, you think that nobody has an edge. Do you think any of these institutions get wind of it beforehand? Yeah, I mean, several of you already, can agree that, absolutely. There's word traveling on the street. Now, it doesn't travel in one instantaneous blinding moment of the obvious to everybody at the same time, right? It's one of those that's a gradual process. That, in my opinion, is why trends exist. Some people are on them earlier, some people are on them later. Some people are bailing after the gap. And remember, of course, like we said, okay, even if you're waiting for a retest, and if you were on a retest and then it was wrong, you get right back out. So you can see since then it's been a little choppy back and forth, unless you were trading the hourly chart, which has been a little bit better, as you can see, catching, a couple of these little moves down, especially that nice acceleration move that happened back there December 12th as the stock steadily edged down from 157 to about 150 and a half over the next couple of days. We were actually bearish that day before, saying IBM was setting up for a breakdown on some other stuff we were looking at. So the point there is, and that we've got a lot of lines there, I know, for a lot of you, but it's actually a relatively narrowed down line. I've looked, like I said, at thousands of systems and hundreds of different indicators, and basically kind of boiled it down to the best of the best handful or so, okay? Now, what about managing ignorance? I never want to assume that I know it all. You shouldn't either. No matter how long you've been trading, always look for that next opportunity to really take advantage of, that best of the best kind of trend. So for me, one of the keys that you need to have as a value system is that you always want to be learning. You don't want to assume just because you graduated from college or you got your PhD that your learning journey is over. Life is a continuous path of new learning opportunities, and thus you can take advantage of opportunities when you're more aware. If you don't have the awareness, you're probably going to stay stuck where you're at. Okay, so this is a way to kind of break through that with additional learning elements. Hopefully I'm showing you some things tonight that are giving you a little taste of some new and fresh approaches to the market that can open your eyes to new opportunities. You want to know where you're strong and where those blind spots are so you make sure that you don't get run over. You should be reading at least one trading book a quarter or picking up other good online educational materials, and so we have regular archives for our students. Quick element on managing hope. Do you ever find yourself rooting for a trade, kind of cheering it on or kind of saying, come on, get going here, kind of getting a little emotional about why is this thing not moving yet? If you're doing that, that's your ego. Your ego desires to be right. It's saying, come on, I got my ego at stake here. Well, you shouldn't. Good traders know you got to accept being wrong sometimes, but you just shouldn't be wrong for very long, okay? So make sure you're following your system or that you have a system to follow, because if you move towards hope, it gets to be a slippery slope. Now, as I showed you before, low-risk entries, that's really the whole nature of the game for me. I'm looking for opportunities all the time to hop on board, and if I'm wrong, not get punished too much, not get knocked too much, basically allow myself to be wrong and get stopped out quickly if it's not working. Even consider, this is a good idea, considering time stops. When you're getting into option trades, if you're in a non-mover and you say, well, I'm not down any after, say, 5 days or even 5 hours if you're using an hourly chart, if I'm flat after that period of time in my particular time frame, I say, bye-bye, sayonara, let's move on to something else. And then managing greed, I think a lot of traders equate luck with skill. Although they blame somebody else if they have a bad luck gap against them, they think they're geniuses if they get a lucky break. Be sure to know what's true trend skill versus what's just happened to be a gap lucky event for you or against you. Basically, like we said, greed is a lack of fear. You don't want to overcommit your capital. So always stay even. Don't get too high or too low off of a winner or a loser. Just make sure you're following your plan, okay? Now, when you look at the top problems of traders and you think, how many of these obstacles have you encountered? Not pulling the trigger, not getting out of your losers fast enough, letting your profits mostly slip away, or worse, letting a winner turning into a loser. Taking quick profits because you're afraid of that profit slipping away, or taking large losses where you should have been out earlier. Hurt by the adverse market moves. You might be in the leading stock and then the market goes down and that leader gets whacked even harder. What about overtrading or hypertrading? You take a loss, you feel like you got to get it back quickly, and you overtrade, or what I call a revenge trade. That's not what you want to do. Maybe you get too fearful or greedy. You react based on those emotions. Or you get too overconfident, that ego kicks in and you overcommit your capital and get not just a risk of a financial drawdown, but also a risk of a psychological drawdown. Or lastly, information overload. I know I'm throwing a lot at you, trying to maybe have you drink through a fire hose a little bit, trying to pack in years of experiences into an hour. But, the principle is we want you to understand how you can conquer these problems. And you see that every one of these problems that you have as a trader, and we all deal with them at different levels, every one of these you can see is a psychological challenge. And I believe these psychological challenges can be overcome with education. So a big part of what we teach you at Big Trends is how to actually take advantage of that. So what I would encourage you to do, let me show you what we've got for you here tonight. And again, a lot of this comes from, lessons I've learned over a lot of trading. You can see actually like weekly options. We'll look at a weekly options chart or two here in a second. This is our weekly options chart really after the mid-October market bottom, and you can see we're still doing some put trades too, but we were calling out live trades for our weekly options accelerator clients, and you can learn how to do this through the weekly options boot camp I'm going to tell you about here in a second. But that kind of consistency is what a lot of folks are telling me they're looking for. That we say, okay, look, they're not any home run trades over 100% here. We had one second half of a Caterpillar put that was up 73.9%, but mostly we're taking that first profit out about 30% on the weekly options purchases, sometimes a little higher, like GoPro is a little higher, Netflix puts was a little higher, but then we're booking the rest where we can at a second target, or sometimes we book the first profit at 30%, and then Exxon, we had a put, and Exxon gapped up there in early December, and we actually took a small loss on the rest, but the whole position was still a small profit. So the point is it's about risk management in that kind of situation. You take the risk out. Amazon, first piece on a put was 30%. Puts sometimes, if you're on the wrong side on a gap up the next morning, it can be flipping against you, and this one got knocked out at a 2.5% loss on the rest. So it only made about 13.5% on that trade. Okay, so the point of this is that how do we do that? And let me show you how we do that, actually. We go to our boot camps. Now, our Big Trends boot camps, this is very fresh material. This is stuff that I've created just in recent months. So this is stuff that literally I've learned across 25 years of my own trading experience and helping literally thousands of other people at bigtrends.com to benefit from that. And so what we've set up is a special page link here for you. It's bigtrends.com/bootcamp. I'm going to come back in and pick up a few more questions here before we're done, but I want to walk you through real quickly first how you can take advantage of this, because what I'm doing tonight for you is usually any one of these would be selling for around $299, because you're talking about 3+ hours of content, and you know that even getting one good idea out of any one boot camp course could potentially save you not just hundreds but potentially thousands, or help you to really start finding a lot more profit opportunities that can be worth that or much more. Now, so the weekly options, we teach you about that overview of the weekly options system I was just showing you the results on in the last several months. Those trading rules for bull and bear signals, how to scan for new opportunities, and how to use the multiple time frames to your advantage. I'm going to show you an example here in a second of an option chart too, so you know what we're talking about when we say the word option charts. That alone would usually be $299. But what I'm doing for you tonight is I'm actually giving you not 1, 2, 3, 4, but actually access to 5 different boot camps that I've done in recent months. And what I'm going to also do is an extra bonus. Those are on-demand instant access, high definition, very great quality. We've had rave reviews on them, and you're getting all 5 of these to kick off your new year in 2015 and start really positioning yourself to understand options better and understand how you can really leverage the opportunities that you see from the charts that you'll learn from us as well. But then what I also am going to include for you, so you have a live component here as well, is a 1-month membership access to my regular training process that I do for my coaching students and fellow Big Trends traders called my trading workshops. This would be usually $199 a month. For once every week, we'll actually go and walk you through live, and you'll get archived access to go see what I'm doing week in and week out on all these different types of strategies. So it's not just the weekly options you get, the swing trading. You see each of these tabs, I'm clicking on them, have the course outline. And they're fairly broad course outlines for each session. The trading rules is typically where we're going to start for both bull and bear swing trades, then how to scan and find new opportunities with filters and how to allocate your capital properly, and then a lot of case studies. Every one of these courses and boot camps has the case studies to really help you to be that much more effective. Now, a lot of people ask me about credit spreads and debit spreads and option strategies. What I did is with actually one of my fellow co-portfolio managers, Moby Waller, who was on the CBOE, Chicago Board Options Exchange, as a market maker back in the 90s. Now has done a lot for me here at Big Trends for years. The bottom line is that we walk through all the different ways you can set up a credit spread. This is how to generate income out of option strategies, how to start basically trading like the house and actually start basically pocketing money up front, kind of like an insurance company would, and then basically structuring the trade to pocket that money once the trade has gone by. Give you a lot of lessons there, and then we even teach you about, you've probably heard about iron condors. We actually show you how you can trade iron condors as well with the big trends methods. Now, for more of a growth and income strategy, it's what I call the debit spread approach. Debit spread essentials, learning that, the rules, and then you can use it on any given time frame, whether you're a quick 1 or 2 day trader, a swing trader over about 3 to 5 days, or more of a position trader over about 1 to 4 weeks. And debit spreads is where you buy one option, you sell another option to lower your net costs, but you basically generate some extra premium doing that, and thus can stabilize and improve your consistency. We walk you through our key ETF rules for how to find the right ETFs to trade, bullish and bearish, and then how to use that with option strategies. And then, like I said, the workshops is walking you through all the key components that I do every week for all my big trends, really dedicated students that want to keep enhancing your trading knowledge. This is a kind of continuous way to do that. So how you can get started today is on the Add to Cart button. You can see we've put in all 5 of those boot camp classes. That's more than 15 hours of content. And the beauty is you've got lifetime access. See the word lifetime there? It gives you lifetime access to all of these classes. And then also what you have here is that lifetime access plus a month of the workshops. You can add up all those numbers down below, and you'd literally be up to like $1,680 of value, something like that. It's insane that we're actually offering it to you tonight. It's my way of saying thanks to Gene and Bennett for allowing me to kind of help you get your new year off to a fresh start with a lot of fresh concepts. Get all this content and the workshops live for just $395. Okay, so that's giving you incredible value. Or you can get the all the boot camps plus 12 months of the workshops for just $995, which is also an insane value because usually that's $995 is as low as we'll go on the workshops themselves. It's like getting all the 15 hours of boot camp access added at no additional charge on that particular piece. Just click on the text if you want that longer-term workshop access. If you want to just try it out for the next month and get the lifetime access to the boot camps, just hit the Add to Cart button. I'll walk you through that real quickly for just a minute. I know I'm already getting over my time, but basically it'll show you what you're getting as all part of that. We've already applied the best possible coupon to that. Like I said, taking $1,680 of value down to less than $400. That's more than 75% off tonight. I'm not going to leave this out there very long because it's frankly too low of a price, but I know you're going to love it, and then that'll likely lead you to referring us to other people as well as wanting even more of what we can share with you over time. So bottom line is hit the green checkout button when you're ready to go. And that directs you to our secure page, and then it just has your key fields in bold that you need to fill out, as well as the key information on your credit card. We take all the major credit cards here and PayPal now. And if you've been helped by Chris, who's in on the call, to get set up, I like to encourage you to give him credit because he's taken time from his family tonight as well. Appreciate it, Chris, and hopefully it's been helpful to you. And then check on the terms and conditions once you reviewed that link down below, and it walks you through all those details on the terms and conditions link. We're all about 100% transparency of big trends. Like I said, on our 16th year of doing business for folks here at Big Trends, and excited to be able to share with you these perspectives. Now, let me go back real quick and just pick up a couple of questions. I know that's an insane deal, Rodney. Thank you. I appreciate the kind word. So kind words about the value you see there, and I know you're going to enjoy it. Okay. Now, let me pick up a couple other questions, and I'll let Gene and Bennett wrap it up for me here. But Terry asked what was the yellow curve within the bands. That's just a trailing moving average, Terry, but we typically will use your percent R retracements a lot more than we would look at the specific moving averages, because a lot of people are looking at moving averages. You want to do something that's a little bit different than the rest of the crowd. You know, when you think back, I'm going to share one more chart with you that's kind of an eye-opener. You know, you think back, you know what's been happening with oil prices. You're benefiting from it at the pump overall, although they haven't brought gas prices down nearly as much as they should for how far oil has fallen over the last 6 months. Look at this incredible chart. This is the USO ETF. And you see we got one signal that made some money here from August and mid-September. But look at that last sell on oil prices when we went oversold, 33.77. This is the tracks oil prices. It's not equating to crude oil per barrel, but the idea is, look, from 33.77, you see today we finished at 18.37. We're down 15 points from a base of under $34. That's talking about a drop of about 45% here just since early October, basically in 3 months' time. That shows you the power of the of these big trends indicators. And let me just show you, for example, let's say that back then when it was at $34, let's say you bought a fairly conservative January 36 put, okay? So you said, you know what, okay, a couple points in the money if it's at under $34, I buy a 36 put. It should be worth about $230 intrinsically, and you can see out here I'd have to pay about $290 for it in early October, $295 even. So call it even $3. Well, you can see, look at where it closed today, $17.77. You know, why would you ever mess with low-price stocks or anything like that when you can take something from $300 a contract and turn it into more than $1,700 a contract, or at least part of that. You know, we would, of course, typically book a first profit, a second profit, and then try to find another spot to re-enter on the next retracement, retest. Okay, so that's how we like to trade here at Big Trends, is show you the big trends and show you how you can take advantage of that with tools like option charts, which you'll learn about through the boot camp sessions as well. So hopefully it looks like that's all the major questions for now. If you have other questions, you can always reach us at our 800 Big Trends line, which is in the top right part of the box here, 800-244-8736. And go to that page, bigtrends.com/bootcamp. Like I said, it's not going to be around at this low of a price for that long. So do make sure you take advantage of it, and we stand by to answer any questions you have along the way, too. You can email us or give us a call to our 800 Big Trends line. And again, I want to thank Gene and Bennett for having me to share with you how you can start off your new year in 2015 on the right foot and take advantage of the volatility that these markets offer you on both sides. I do believe that my outlook for 2015 is a net positive one, even though we started the year on a little bit of a slow note, but you're going to see opportunities in both directions. So there's always a bull market and a bear market somewhere. Your job as a trader, and in particular as you get to be an options trader, is to take advantage of those significant trends that are happening out there. So, so from this perspective, you know, we're looking for opportunities, and like Rodney mentions, a lot of people don't even know about option charts. You'll start making yourself aware through the training, like in the weekly options course. We teach you what's an option chart, why you should care. If you're trading an option, you need to know how your option is moving compared to the underlying stock or market. So we'll open you up to a whole bevy of new ideas, literally, I think, open you to a whole new world, and one that I think you'll be very excited to start adding all these trading tools to your arsenal. So without further ado, I'm going to hand it back over to Jean so she can wrap it up, and I want to say thank you to Jean and Bennett. Wish all of you all a very happy new year and a very prosperous new year. And if you have any questions, give us a call. But do make sure you get to that bigtrends.com/bootcamp link before the end of the day tomorrow, because I can tell you it's not going to be around too long. We did record today's session. Gene did, and Bennett. Thank you all for doing that. And so we'll try to get an archive out to you tomorrow. But if you have any questions, give us a call at 800 Big Trends, and we look forward to serving you and helping you to charge ahead in 2015 while also teaching you how to manage your risk along the way. So that's a big part of it. It's not all about upside. It's also about controlling your risk and then taking advantage of opportunities when they present themselves. Again, thanks, everybody. Have a great night and great trading year ahead. We look forward to serving you with the Big Trends boot camps and through the weekly workshops, which are live as well. So take care. See you soon. And, Gene, back over to you.
Bryce, thank you. That was a terrific presentation, and I think also this is a fantastic offer that I know a lot of our clients would be interested in. Options, of course, are a very big item that our folks are very interested in, and I know you can help them with that. And also thank you for a great presentation on how to set up your written trading plan. So everyone, thanks for joining us tonight for another edition of Wednesday Night Live. We look forward to seeing you again next Wednesday and every Wednesday. Next week we have Alla Peters with Alpha Wave Trading, and we hope you'll join us. Have a great night.